You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to The Investor Way with me, Sam Ball, and my co-host John McEwen. In this week's episode, we'll be discussing Trainline, Shell, GlaxoSmithKline, Sainsburys, BT, and aapl. John, should I kick us off with Trainline?
Go on, Sam.
So Trainline, anyone who doesn't know, they are the app that you can use to buy your train tickets. They have come out with their half-year results, and they've announced net ticket sales of 1 billion, which is up 179% year over year. Revenue of 78 million, which is up 151%. Adjusted EBITDA of 15 million, which is an improvement on a 16 million loss last year. Operating loss of 9 million, which is an improvement on an operating loss of 43 million last year. Adjusted loss per share, 1.1p, and that compares to a loss of 6.2p last year. Operating free cash flow is 72 million, and that compares to an operating cash outflow of 80 million last year. And net debt has increased year over year from 166 to 169 million. They've highlighted that the top 4 domestic markets in international, which is France, Italy, Germany, and Spain, have returned to growth, and they're up 5% overall versus the same period 2 years ago. And the UK consumer segment of the business has recovered to 95% versus the same period 2 years ago, and it returned to growth in August. They've highlighted strong progress against their strategic growth priorities, and that includes an accelerated shift to online and digital tickets, with UK industry online penetration increased to 50% and e-ticket penetration to 40%, with significant runway ahead. They launched features for the new commuter in UK, including the 2-click rebooking and flexi tickets, converting 26 more time checkers to customers. They've been increasing transaction frequency, with a 29% increase in customers that transact 2 or more times a month in the UK. They highlighted scaling marketing investment as COVID restrictions ease, the highest ever new app customer acquisition and unique monthly active users returning to 30 million. They have announced they're integrating Trainline into Google Maps for Android users in the UK in September. Oh, they integrated it in September. I haven't noticed that actually. And they're scaling digital rail cards with over 250,000 sold in the UK in the first half, and they've now launched this in France. They've highlighted that they've still got significant headroom for growth in Europe and strong momentum where carrier competition exists. In Italy, the growth was 95% in net ticket sales versus Q2 in the same period 2 years ago. And in Spain, transactions tripled on the Madrid-Barcelona route in Q2 versus the same period 2 years ago. For the full 2022 financial year, they've given guidance in line with the trading update that they issued on the 14th of September, which is net ticket sales in the range of 2.4 to 2.8 billion and adjusted EBITDA in the range of 35 to 40 million. There are a couple of interesting points in the slides. So yeah, in the international, for the second quarter of the half, net ticket sales were 105% of the same period in 2020, whereas in the first quarter, they were only 75%. And for the UK, net ticket sales went from 49% compared to the prior period 2 years ago in the first quarter of the half, up to 95%. So it is actually basically back to normal, it looks like. And where he mentioned before that in the UK, e-ticket penetration is now up to 40%, that means that e-tickets as a percentage of total UK industry sales have doubled now in the last 18 months. So you could possibly argue they've actually, although there's been a significant delay, because when we first looked at them about a year ago, turnover was down 80%. In the long term, they possibly are a beneficiary of COVID, just because it's forced so many more people onto the e-tickets and the apps. And in terms of the digital rail cards, which they've started doing, they sold 250,000 digital rail cards in the first half. They've highlighted the size of the opportunity with 6 million rail cards in use in the UK and over 40% of Trainline's transactions using a rail card. So in terms of the valuation, they trade at a market cap of 1.57 billion. They don't have any earnings. If you were to take the full year guidance, which it seems pretty clear they're going to hit, given that it's already in line with a trading statement they've already issued. But if you take the midpoint of their guidance, that would put them at a price to sales of 1.65, and they would be trading at 41 times their adjusted EBITDA for the year. In terms of the share price, the shares are trading at £3.23 a share. That compares to a 52-week low of £2.53 and a 52-week high of £5.36. And they're still down a fair bit from pre-pandemic levels when they were about £4 a share. My view is we've been critical of this business the last couple of times we've covered it. This is possibly the first time I think I've looked at it where it's starting to look like there is actually a decent business there. I still question the overall size of the market, whether the government would just nationalise it at some point.
It sounds like with the government's plans more recently and developing a railways ticket website and app, that is essentially what Trainline operates on now, or is now.
Yeah, so although it does look like the first time this is actually starting to look like a decent business, I wouldn't pay 41 times adjusted EBITDA for it. I think it's too expensive still. What about you, John?
Exactly the same. And I think it's just the model overall. If it's essentially nationalised, there isn't really much of a business, if any business left at all. So I wouldn't be touching it with a barge pole at the moment.
What do you think of these results compared to the previous results we've looked at?
I mean, they're good results, I think, but I suppose if you're comparing it with last year, it's sort of low bar that's been set. I suppose if you're comparing them historically, since it's been public, they're not bad. But it would be the business model as a whole with the prospect of effectively nationalisation that would be worrying me and would make me not even consider the shares.
Yeah, I think there's better options, and I do question what the upside actually is. I find it very difficult to actually say, well, this is how much I think they're going to make, because whether it's 40% e-ticket penetration, it's never going to get to 100%. Unless, well, they might take away the physical tickets, so maybe it could, but it's going to take a very long time. And even then, like, you don't have to use Trainline. A lot of the train providers, you can just go directly through them. So it's never going to get to 100%. And I just find it very, very difficult to say, well, where is it actually going to get to? So then for that kind of price, it's probably just a bit too risky for me, I think, just because I can't say, well, I could see there's been a £10 billion company. It's only 1.5 billion now. I just don't know how big it could get and how much money it could earn in the future.
Yeah.
So should we move on to Shell then?
Okay. So Shell, the FTSE's largest company, they had their third quarter results out last week, with total revenue for the quarter coming in at $61.6 billion, a 37.7% increase year on year, despite a modest decline in production. Profits actually fell from $177 million a year ago to a $988 million loss this quarter, as derivative losses in the integrated gas business more than offset the improvements in the upstream oil and gas production. Excluding the effect of these and other derivative movements, underlying profits were up more than 3 times to $4.1 billion, and underlying cash flow reached a record high. If we break the results down a little bit more, the integrated gas business reported a loss of $3.2 billion, with underlying profits after derivative movements are taken out of $1.7 billion, more than doubling year on year, reflecting an 11.1% increase in production, with a Prelude LNG liquid natural gas platform restarting production along with higher prices. Underlying operating cash flow from the division nearly tripled. Typo on my part. Underlying operating cash flow from the division nearly tripled to $7.8 billion, and CapEx up more than 24.7% to $1.3 billion. In the upstream division, reported profits were $1.3 billion, with underlying profits of $1.7 billion, up from the $884 million loss 12 months ago. Production was down 5.5% year on year, with a negative impact of Hurricane Ida being felt, but more than offset by the higher oil and gas prices. The division reported underlying operating cash flows of $5.9 billion, more than double last year's figure, with CapEx coming in at $1.5 billion, a 20% increase. The oil products division reported a $1.4 billion profit, 1.2 billion of which was on an underlying basis, down 27.9%, with lower refinery intake, in part again due to Hurricane Ida. Chemicals had profits of $357 million or $395 million on an underlying basis, up 74% year on year. Underlying operating cash flows in chemicals came in at $684 million, a 40% increase year on year, with CapEx up 77% to $1.1 billion. Shell reported free cash flow of $12.2 billion, a 61% increase year on year, or $11.1 billion excluding acquisitions and disposals. Net debt was down from $73.5 billion a year ago to $57.5 billion. And in September, Shell agreed the sale of the Permian business for $9.5 billion, $7 billion of which will be returned to shareholders in a buyback on completion expected in 2022. And the group also announced a dividend of 24 cents a share, which is a 44% increase year on year, but in line with the dividend announced in the last quarter. In terms of valuation, Shell has a market cap of $130 billion, being the FTSE 100's largest listed company, and its forward price to earnings is 8.4, and that compares with a 10-year average of 11.5, and it currently yields just over 3.5%. I mean, to me, Shell looks like it's in a very strong position, especially with oil trading at over $80 a barrel and gas prices continuing to rise, and I suppose the world economy getting back to normal. One of the things that's been more controversial is the strategy and the amount of green capital expenditure, and the company agreeing to halve their carbon emissions by 2030. I suppose the core business for Shell always has been the traditional oil and gas. I guess there's that sort of division in shareholders, whether they actually think it should be trying to get into renewable energy and whether that's the future of the business, or whether it should sort of almost accept that it is a business that's in structural decline and return all of the profits to shareholders in the form of share buybacks or cash, a bit like some other companies, namely the tobacco ones that are also listed on the FTSE, that are again companies in structural decline and are increasingly now returning money to shareholders, or should they be putting more money in their next generation products? I guess that's a bit of an argument that's going on and dividing shareholders in terms of the future strategy. The other thing might be whether, even if it does change its strategy, are people going to abandon it regardless of the company's performance on an ESG basis? I guess that's another concern that's possibly depressing the share price a little bit. What are your thoughts on Shell at the moment, Sam?
I mean, they are very good results for starters. On the surface, I think a forward PE of 8.4 seems quite reasonable, but that is with the oil price at the highest it's been in 5 years. I know we're like looking around at the minute and saying, well, what's actually going to bring it down? But it's easy to remember a year ago, we were sat here saying, well, what's going to cause it to increase? And it can change very quickly. So if the oil price starts dropping on the current valuation, that PE of 8.4 would soon change. If the oil price stays the same, I think it looks quite reasonable. In terms of the future of the business, if I were a shareholder, I'd be on the side of they should behave like a tobacco company and return all the funds to the shareholders. And if the shareholders then want to go and invest in renewable companies, they can do that. But Shell is an oil and gas company. And I think trying to pivot the business towards renewable energies just so that management have something to continue to manage, it just seems a bit, they may as well just return as much cash as possible. I think that would be what was best for shareholders rather than trying to get into these renewables. And it's hard to say which renewable is going to take it. They could go all in on hydrogen, and it might not even be hydrogen it might not even be hydrogen that takes off, and they could have all this capital expenditure that's just wasted that could have gone to shareholders. So I sort of get why they're doing it, but I'd probably, if I was a shareholder, have preferred them not to. Do you have any preference?
I would probably side with you, and or if they, I mean, I suppose that one of the things they could have is a separate company under this Shell umbrella. But no, I would prefer to have a pure play oil and gas company myself.
I could get behind a separate company as well, actually. I think that would make more sense. But yeah, it's like, which one is it? It was one of the big tobacco companies in the US. I think, I can't remember the name of it, but it was the one that owned is it Philip Morris?
Yeah. In terms of,
they did, they started doing like asthma products and stuff.
Oh, the Vectura.
Yeah,
they bought Vectura. Yeah,
it's just like, I don't know, like, I'm asthmatic and I wouldn't get a Marlboro inhaler. It's just ridiculous.
Well, yeah, I mean, I don't think it would be branded as such, but yeah, I take your point. What
are you doing? So that's my view on it. But no, as long as the oil price stays where it is, which is a very big if, especially when you think about where it was a year ago, and it looks like nothing was. I would never have guessed the oil price would be where it is now a year ago. Never.
No, well, I mean, the share price was literally half the price. You know, it's doubled in a year, so it does reflect that. But I mean, it's not. I know the oil price is historically quite high at the moment, or certainly for the last 5 years. But it's not an expensive valuation, is it?
But those earnings are somewhat tied to the oil price, so that's the problem. So if the oil price gets cut in half, it's actually at a forward P of 16. If you assume the earnings will also get cut in half, that's the issue with it. But then the oil price. We could be sat here in a year's time and the oil price is above 100.
Yeah, no, that's true. That's not inconceivable.
And if the oil price is above 100 in a year's time, then it's probably pretty cheap. So it's difficult.
Yeah, and the world does need fossil fuels. It's easy to say, well, it can transition, but I don't think it certainly can as quickly as people are saying it can.
Yeah, it's not going anywhere anytime soon. That's fair to say. Right, should we move on to GSK then?
Yeah, GSK.
So it's GlaxoSmithKline. So they are one of the big two pharmaceutical companies listed in the UK, with the other being AstraZeneca. They have come out with their Q3 results, and they've reported third quarter sales of 9.1 billion, which are up 10%, ignoring the effect of exchange rates. There was growth in every division, with double-digit sales increases in both pharmaceuticals and vaccines. Underlying operating profits rose 16% to 2.9 billion, reflecting higher margin pandemic sales, strong growth in new and specialty products, and ongoing cost control efforts. The group announced a quarterly dividend of 19p a share and continues to expect full year dividends to reach 80p a share, and that's on a share price of £15.79. GSK improved its full year earnings per share forecast to a decline of 2 to 4%, excluding the impact of COVID-19 solutions, which are expected to add between 7 and 9% to underlying EPS. I do actually question why they split it out like that, to be honest, because I think if they're a pharmaceutical company, they shouldn't need to exclude the impact of COVID-19 solutions. It's sort of what they do, isn't it? So I'd treat that as an increase in earnings per share. But anyway, so splitting it out by division, sales in the pharmaceuticals division rose 10% to 4.4 billion, and that was driven by a strong growth in new specialty products and strong sales of Chevody, maybe? Monoclonal antibody treatment for COVID. This is somewhat offset by a decline in the established pharmaceuticals portfolio. Increased sales of both Shingrix and the pandemic adjuvant means vaccines reported a 13% increase in second quarter sales to 2.2 billion. And excluding the impact of pandemic vaccines, the division sales were up 8% to 2.1 billion. Consumer healthcare sales rose 8% to 2.5 billion, excluding the impact of brands that were being sold or considered for disposal. Sales grew 10%, helped by an easy comparison due to restocking in the US last year and anticipated price rises in the US. Spending on research and development increased to 1.5 billion from 1.1 billion, excluding the one-off charge. R&D spending was up 15% to 1.2 billion. Free cash flow was 1.2 billion for the quarter, up from an 180 million pound outflow last year. This was due primarily to increased operating profit, helped by a decrease in inventory and favourable comparisons to last year. Net debt at the end of the quarter stood at 22.1 billion compared to 20.8 billion at the end of December. £3 billion in dividend payments were primarily responsible for the increase. I do question that decision. It's worth noting as well that they are planning to separate the consumer healthcare business in a demerger in mid-2022 that would hand GSK investors shares in a new consumer company. The new GSK is what will be left behind, and that will just have the pharmaceutical and vaccines businesses. It will retain a stake in the newly listed company, but that will eventually be sold off to help shore up the balance sheet. And in terms of the debt pile, the way that's going to be split is that the consumer business will start life with net debt to cash profits of 4x, which is fairly high. And the new GSK company will have 2x, which is pretty low. In terms of the valuation, the company's trading at a PE of about 13 and a dividend yield of about 3.4%. And that's after they cut the dividend by about a third in the last year. John, thoughts on GSK as a company and these results?
I think the results were good. I think it's probably also good that they're splitting out the business. So I suppose the argument had always been that the more reliable earnings from the consumer health division would support the sort of bitty earnings and the ups and downs, the turbulence of the pharma play, which I think most people who would be buying Glaxo that's probably what they would be buying it for. And then Elliott's investors came in, or Elliott Management, whatever they're called, the US hedge fund came in, and they've essentially been the activists, and they forced the hand of Glaxo to split it out. I've probably in recent years preferred AstraZeneca. I think they've got a better pipeline of the sort of what would be future blockbuster drugs. And it definitely is something that's reflected in AstraZeneca's valuation. But I think if you're buying a pharmaceutical company, I would want a more pure pharma play, I think. So at the moment, I wouldn't be that interested in Glaxo. And I think it's probably the company that's underperformed when it comes to pharmaceuticals in the last 10 years, reflected in the share price. And you've always, I suppose, in the last 10 years had a stronger dividend with Glaxo, but you've had that lack of growth, which you haven't obviously had with AstraZeneca. So despite the results being good, at the moment, I probably wouldn't be buying it. I might take another look at it in a couple of years' time, especially when the consumer health has been spun out. What do you think?
Well, it does go in the too hard pile for me because I can't evaluate anything that involves like a product pipeline. But I thought they looked like good results. I don't like that they're increasing the debt just to pay the dividend. I know they've cut it by a third, but if debt's increased by 3 billion just so the dividend can be paid, I'd say it needs cutting again. That would be my and especially if you're saying their pipeline's not as good as AstraZeneca's, perhaps that money could be better invested in the pipeline. I think the split, I can see the logic to it. It's not like looking at either company, you're going to look at it and say, well, that one's doomed to failure. I think with the consumer goods one, debt of 4 times cash profits, it's probably on the higher side, but it's definitely manageable. And if it is something fairly consistent, like the consumer goods side, that should be fine. But I don't think either of the separate businesses would probably excite me that much.
I mean, I suppose it's the potential for the turnaround in the pharma business. But I'm not sure what the pharma business are going to do in terms of the dividend. Like you say, I think if that's a separate business, you'd definitely be looking to cut that down and be reinvesting it into the R&D in the pipeline.
If they know they're splitting in two anyway, I don't know why they're messing around with why not just, they could have just cut them completely, try and get the debt down for both companies, and then each separate company can decide its own dividend policy after that.
Yeah.
Just seems not the best use of capital allocation, but
yeah.
There you go.
And certainly if you look at the share price, and this is obviously excluding dividends, in the last 10 years, it's up about under 15% compared with over 200% of AstraZeneca.
It's only up 1.42% over 5 years.
Yeah.
It's poor that. I suppose you have had a decent dividend, but if you get a nice yield and still underperform the market overall, you'd have been better off just selling some shares in a company that was actually growing.
Yeah.
So.
Quite. Okay. So next company.
Next we have Sainsburys.
Sainsburys. So Britain's 4th largest supermarket had their half-year results out. with half-year revenue excluding fuel coming in at £14.9 billion, more or less in line with last year's figures, but up 7.3% on pre-pandemic levels. However, with COVID costs falling, underlying operating profits increased 8% to £542 million. And in a little bit more detail, if we look at it, total retail sales, including fuel, were up 6% to £17.3 billion. However, that retail underlying operating profit was actually down 5.7% to £523 million, with the group's decision to take on the business rate relief during the COVID pandemic before later rejecting the aid after the results were published. Supermarket sales were down 0.5% compared with an 11.8% increase last year, with online sales growth of 12.8%, but a 3.3% decline in in-store sales. And sales were actually up 4.9% in the Sainsburys locals, the convenience stores. Grocery sales were up 0.8% to £11.3 billion, but were moderated by second quarter easing of lockdown and people going out. General merchandise sales were down 5.8% to £3.1 billion, with tempering of demand for home office and entertainment products, and sales in Argos were 7.3% lower. Clothing revenues rose to £0.5 billion from £0.4 billion a year earlier and were 9.1% ahead of 2019. The total estate size shrunk to 1,409 stores from 1,411 since March, and the group planned to reduce the Argos estate to around 100 stores by 2024, but increase the number of collection points. Financial services division was up to sales were up to £183 million from £165 million, but income was below the pre-COVID levels with lower consumer balances. It was a similar story when we looked at Tesco's. Free cash flow for the half was £759 million, down from £1.3 billion last year, and net debt came in at £6.3 billion, which is up £177 million from last year. In terms of valuation, Sainsbury's has a market cap of £6.6 billion and trades at 13 times earnings, compared with a 10-year average of 11.6, and it currently yields just over 4%. So, I mean, the results, I think, fair to say they were pretty good, not as good as Tesco's when we covered that. And I'd say overall, the business is probably an inferior one to Tesco's, but it definitely isn't trading at the premium of Tesco's. So I suppose you could say there's a little bit of value there. But I think as a Tesco shareholder, I'd be sticking with Tesco's as the superior business. What would you say on that, Sam?
Very, very similar. I'd actually written down the exact same phrase as you. All I've got under these half-year results is not as good as Tesco.
Okay.
I mean, Tesco actually managed to beat the COVID figures. I know they only beat it by like 2% or something, but compared to a slight drop for Sainsbury's, it just seems a little bit disappointing. I agree that you've got to pay up for Tesco, but it is the better business. I think it actually made me think it's a bit of a shame that we don't have Morrison's as an option anymore, because Morrison's was, I felt like it was a higher quality business than Sainsbury's, but it was still a low valuation compared to Tesco. I think Tesco's at P's in the low 20s, and Morrison's before the takeover, it was at like something like 11 or 12. So it was a pretty similar PE to Sainsbury's, and I just felt like it was a better business. I don't know what the results would have been, or if they've come out. We've obviously stopped looking at it because you can't get shares anymore. But I know we don't actually really see what goes on inside Asda. But to me, of the big four, it probably feels like the fourth best, and I don't know why you'd want the fourth best.
Yeah, I suppose if you were to play, well, no, that's true.
I couldn't think of anything positive.
No.
I don't really like Argos either. It's not really a business I actually understand. I know Argos is apparently it's been fairly good for them, but it's not. If Argos was listed separately, I would never want to own it. Whereas I may consider a supermarket. So having Argos, it makes it less attractive. They don't have a bank, do they, as well? It just says financial services. I hope that's not a bank.
I think so. Yeah, I think no, it does. Yeah, it's. I don't think it's as big as Tesco's, but
I don't like banks. I don't know. Oh god. Yeah, it's not for me.
But I think they're certainly at Tesco's, it's more a legacy which they're trying to offload.
They must be able
And
to
they-
float. Just sell it to Lloyd's or someone will buy.
They did. Well, Tesco's did. They sold the mortgage book to Lloyd's.
Yeah, just sell everything. Just get rid of it. It's not what they do. I don't get it. I know,
Yeah.
like, I understand how it's come about. It's when they would, like, you went into Tesco. You used to go to Tesco's and they had roller coasters in there and everything. And
gyms.
Yeah, just you name it, you can get it in Tesco. Cinema, bowling.
Well, giraffe. They used to have giraffe and coffee. Yeah, coffee change, all sorts of different things. But thankfully, they've sold them off, and they're moving away from that, and hopefully never to go back. But focus on the groceries.
Yeah, exactly. Yeah. So should we move on to BT?
BT. Yeah. Do you have anything good to say about it?
No spoilers. So actually BT, they've come out with their half-year results. Underlying revenue fell 3% to 10.3 billion because of declines in the enterprise and global businesses. Underlying cash profits rose 1% to 3.7 billion, thanks to progress in the transformation program and wider cost management. Results were in line with expectations. BT has delivered £1 billion of gross annual savings 18 months ahead of schedule and has now brought forward its £2 billion annual savings target by a year. The group declared an interim dividend of 2.31p a share, in line with the policy set out in May. The share price is 161p. Splitting it out by division, the consumer division, which is the group's biggest, they saw half-year revenue unchanged at 4.9 billion, which resulted in flat cash profits at 1.1 billion. The division was helped by an increase in direct handset sales, although the performance was held back because of reduced stock availability owing to global supply chain problems. In the enterprise division, revenue was 2.6 billion, and that was down 5% because of continued declines in legacy products, which were partially offset by retail mobile revenue. Cash profits were up 2% at 852 million, boosted by cost savings from the transformation program and disposal proceeds. Got some fireworks in the background. I'm hoping they'll stop. Disposals and challenging market conditions meant global revenue fell 14% to 1.6 billion. Cash profits fell 28% to 207 million. The decline was 21% excluding the effect of exchange rates and disposals. Openreach was boosted by increased rented fibre and broadband products, including fibre to premises products and ultra-fast broadband, with revenue rising 5% to 2.7 billion. Cash profits rose 7% to 1.6 billion. Increased spectrum costs meant capital expenditure rose 30% to 2.6 billion, which contributed to a 15% fall in normalised free cash flow to 360 million. Net debt of 18.2 billion was higher than the 17.6 billion at the same time last year. In future dividend plans, BT said the board expects to continue with a progressive dividend policy for future years and to declare 2 dividends per year, with an interim dividend being fixed at 30% of the prior year's full dividend. I think the dividend policy is very poor given the debt position, and the debt's going up, but it's not like the debt was at a fantastic level anyway. And in addition to the debt, they've also got the pension deficit, which at the latest review, it doesn't look good. The new payment plan is going to cost hundreds of millions of pounds every year for most of the next decade, and that's going to be added to the debt pile, which is currently costing interest of 770 million a year. In terms of the valuation, it trades at a P ratio of 7.1, and that compares to a 10-year average of 10.3. And it ludicrously has a prospective dividend yield over the next 12 months of 5.4%, despite these issues. I think, I said it before, I think it's a poor business, and I think it's poor capital allocation as well. I think if I was a shareholder, I would be wanting management's head on a plate for that. I think it's just unforgivable. I think it's stupid. What do you think, John?
I don't think I'd have anything more to add. I don't like it. I wouldn't be buying it. The debt and the pension deficit are very worrying. I suppose the gem from it is the Openreach business, but it doesn't sound like that's going to be spun out anytime soon. So yeah, I wouldn't be touching it.
Yeah, and Openreach revenue, I mean, it's only 2.7 billion out of 10.3 billion. So it's hardly like it's carrying the whole thing. And the Openreach profits, 1.6 billion out of 3.7 billion. So it does make up the bulk of the profits, but it's got a lot of other stuff dragging it down, unfortunately. And like you say, if it's not being spun out, you're not really getting the benefit. But although I do think it's stupid, like I said earlier, I think part of the reason that management are carrying on with this dividend policy, I think they're aware that people aren't buying BT shares for growth. it is the income investors. They are buying it for the dividend. So I think they know that if that dividend gets cut, the share price is going to drop. But I think they need to focus on managing the business and not the stock.
Yeah. I mean, it's not that dissimilar with Glaxo. I think that's probably one of the reasons that then they're almost not able to cut it significantly.
Yeah, although I think it's a little harsh on Glaxo putting them in the same.
Well, no. I mean, I'd have Glaxo every day of the week over BT, but I think that we were, when we were talking about it a few minutes ago, that was, I think, one of the issues that you'd like to see the Glaxo dividend come down a bit, so the money can be not reinvested in terms of repaying debt, but just in terms of R&D spend.
Yeah. I think I said it last time as well. It's one of those businesses where the debt's just so high, and especially when you're throwing a pension deficit on top of it, the shareholders don't own it, the debt holders own it.
Yeah.
But anyway, should we move on to a much healthier business?
Yeah. So, well, you could say that again. So our US company of the week, Apple, which is actually not the world's largest company this time. It's the world's second largest. And obviously the maker of the iPhone and the Mac. They had their fourth quarter results out, with total net sales rising 28.8% to over $83 billion, with increases across all of their products and services. Operating profit rose over 60% to $23.8 billion, compared with $14.8 billion this time last year. And if we break those results down a little further, Apple saw a 29.8% rise in product sales to $65 billion, with the iPhone accounting for nearly $39 billion of those sales. And the iPhone sales were up 47% on the previous year. Mac sales rose 1.6% to $9.2 billion, and iPad sales were up 21% to $8.3 billion. Wearables, home, and accessories were up from $7.9 billion to $8.8 billion. Services accounted for just over $18 billion of sales, and they were up 25.6%. Every geography grew in the quarter, with Greater China leading the pack, sales rising 83% there to $14.6 billion. Operating expenses increased nearly 15%, with a 16% rise in research and development. Free cash flow came in at $93 billion for the year, and that was up from $73.4 billion last year. And net debt stood at $56 billion at the end of September. Shareholders are going to receive have received $24 billion in the quarter in dividends. And in terms of valuation, Apple currently has a market cap of nearly $2.5 trillion and trades at just over 26 times earnings, compared to the 10-year average of 15. Currently yields about 0.6%. I mean, my interpretation, incredibly good results, with every product category growing in sales and across all of the geographies, I mean, particularly in Greater China. And I'd say Apple, it's got to be one of the world's strongest brands, up there with Disney and even some of those Unilever products. And it was encouraging to see the services growing, particularly, and the proportion of sales there. I suppose one concern in the short term, particularly in comparison with some of the other FANG stocks, is that Apple depends much more heavily on hardware sales than its peers, and it might be disrupted more by the supply chain issues. And I guess also the margins on the services are generally higher. So in the longer term, maybe that's a concern for Apple. But when your results are this good, selling your iPhones and I suppose other, Macs, iPads as well, and the wearables, do you really need to worry too much?
Yeah, I wouldn't be worried. I mean, even if there is a drop, I think it's just going to be, it'd be a year, wouldn't it, until everything's back to normal. It's not going to be a permanent decline. It's an unbelievable business. I think it's interesting as well, because when we say these figures, they are insanely high. When we say these market caps of like trillions, it does like blow my mind every single time. But in 5 or 10 years, it's just going to be like normal. And in like a generation, like lots of like companies will be $1 trillion. It's crazy to think about. But anyway, I can't really knock these results at all. I think if there is a drop in the next few quarters because of the supply chain, there's not really anything they can do about it, and it certainly wouldn't make me concerned about the business in any way. It's interesting because I think it's probably more of a consumer goods company than a tech company at this point. I think to me, it's almost more comparable to like Unilever now than it was a few years ago. That's how I view it anyway. And at a PE of 26, it's definitely quite pricey, but it is such a quality business, and with interest rates so low, I can see why people would make an argument for paying 26 times earnings for it. What do you think of the valuation?
I mean, it's a lot, and I suppose in comparison with those other tech companies, Apple had always been the one that had a lower valuation and certainly wasn't priced anywhere near what it was worth. And then you see it over the last 10 years, and it has delivered. It's been a 10 bagger, and it's always had a price to earnings in the last 10 years of sort of, well, it hasn't always, but it's had a much lower valuation.
Yeah. What would you compare it to then? Would you compare it to the other FANG stocks, or would you be looking at like the consumer goods companies? Because I'd be more inclined to compare it to like the Unilevers and the McCormicks now, because I just think it's just churning out these iPhones and people just buy them. It's no different to like the Unilever customers buying a pack of Pringles. They will just buy them.
Yeah. Are you trying to argue that perhaps compared with it where it was 10 years ago, it's now less innovative?
It's definitely less. Yeah, it definitely is. I wasn't doing it as a criticism. It was more that it's almost got this brand and it's got these products where the products aren't really going to change. I know on the flip side, obviously in 50 years time, Unilever might still be selling, it's probably still going to be selling Lynx deodorant, but Apple might not be selling iPhones. So there is a bit more risk in that element. But I do basically view it as consumer goods. Yeah, and I think the valuation probably needs to be compared to like other consumer goods companies rather than the other tech companies. Because if you compare it to Google, they're both unbelievable businesses. But I think the Google earnings, I mean, Google is a tech company. There's no doubt about it. And I think the Google earnings for me are probably of a higher quality. And I think Google possibly deserves a higher multiple. Whereas, well, yeah, with that PE of 26 for Apple, I'd compare it to like Unilever at like 17, 18. That's where I'd be comparing it.
But I mean, Unilever could dream of these numbers, and I suppose dream of the growth as well. I mean, if you look at the figures and the amount that even the iPhone sales can grow.
Yeah,
and one might argue that the iPhone hasn't been that innovative more recently. You know, it's the recent generations have been quite similar. They're only sort of incremental upgrades. But I suppose I own or have an Apple Watch, an iPhone, a Mac, and I would, in terms of my intention, huge loyalty, and I'd be going to buy them next time.
Yeah, well, despite me saying it's expensive, I can see why people would pay 26 times earnings for a business of this quality. So, of the 6 businesses we've talked about this week, then Trainline, Shell, GlaxoSmithKline, Sainsburys, BT, and Apple. If you had to buy one, which one would it be?
It'd probably be Apple.
It'd be Apple for me as well. There was just something wrong with all of the other ones, really. I'd say the second one would probably be Shell, actually, because the only concerns we really had with Shell, I think, were valuation.
Yeah, valuation. I suppose also strategy.
Yeah, I guess, yeah.
But,
whereas there's quite a few businesses this week that I just didn't like.
No, fair enough. But Apple, yeah. I suppose it always with these great companies, it always does come down to the valuation. I mean, that is one of the stumbling blocks because they don't come cheap.
No. Although 26 times earnings, it's still not.
Yeah,
it could go higher.
Okay. Well, thank you again for listening, and we'll see you again next time.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter @TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.